A lot of people always ask me, what makes it different from like MetaTrader or like NinjaTrader? TechTrader is not a tool. That's what I have a hard time getting across to a lot of people. It's automated, but it's actually all the way automated, like a self-driving car, fully autonomous. It's not there to help you drive or help you trade. It does the whole gamut on its own. It's no human intervention, and it's been live, as Stefan said, since 2012. Quite literally, when I say it's replacing humans, it actually replaced me in my own trading, and I haven't traded since. A lot of people ask me, so what is it that TechTrader does? Because they think like, okay, there's plenty of automated systems out there. There's plenty of people doing automated trading, programmatic trading. Is it quant? That's one question I get asked a lot. Is it stat-arb? Or is it high frequency? It's really none of that. Because what I built was a system that tries to mimic my own trading. And what it does is it copies my logic 1,000 times over every single stock that's out there. So it's kind of like if you were able to clone yourself and just task each one of you to a different stock. The reason I took that approach was because it doesn't really make sense to make a strategy that only trades in one style. And what happens when something unknown comes along? To me, if I wanted to mimic on my own trading, it really had to be self-learning. It had to actually be able to handle whatever came across. An easy analogy would be like, like if you were playing tennis, no one would ask you, are you a backhand player or a forehand player? You got to play the whole thing. It's kind of funny because when I was trading on my own, no one ever asked you, are you a momentum trader? Are you a reversal trader? I mean, if you are a human trader, you trade everything that the market gives you. But when it comes to machines, because most people doing automation are not quite out there yet, they're not, a lot of them don't consider what they're building enough to replace a human being. You get these kind of questions that say, okay, it must only be able to do one thing very well. The other reason why I made it in this format where there's 1,000 different traders, one critique I get a lot in the past is that my system essentially has no portfolio management. I didn't actually know there was something called swarm intelligence back then, but that's essentially what I'm doing. No copy of TechTrader actually talks to each other. There's just quite literally 1,000 copies, each doing different things. And whatever ends up in your portfolio ends up in your portfolio. People always get scared when they hear something like that because essentially there's not really any controls. But it's kind of like induction versus deduction. You kind of have trust in the design. The closest examples we have in nature are like ant colonies, for example. You don't actually have a leader in an ant colony saying, hey, we should explore this path, or we should go in this formation. It's kind of just coded in their DNA. That's the way they've been designed. And it just so happened that when you put a whole colony of them together, they work very well, and it appears to be some kind of macro intelligence. The other analogy I like to give is when you think of like there's an earthquake, right? Before an earthquake, you usually get a lot of animals vacating the city. It's not like God came down from the sky and said, all right, all animals evacuate the city. There's no central command. Every animal just individually picked up cues that said it's time to get out of here, it's dangerous. In the same way, TechTrader also has 1,000 copies of itself that whatever happens in the market, it's each one of them is watching a different stock and seeing it on their own terms. There's no collusion. I think it's stronger in that way, actually, and more convincing, because that means you have 1,000 independent minds all arriving to the same conclusion as opposed to some kind of groupthink. So another critique I often get is that because it's been live since 2012, the backtest all the way to 2002 was pretty great, but since the live performance 2012 onwards was mostly a bull market, people always point that out and say, well, you could have just been capturing beta. First of all, the beta of the strategies is actually 0.4. It's pretty low in hedge fund standards. The other side of it is last year, it was actually up about 30%, and that, to me, was a really, really good test case, a testing year to show that we are not just capturing a bull market. For those of you that don't know, the S&P was essentially flat for most of last year, but TechTrader just kept chugging along like it was the past 2 years. The reason for that is because it's looking at literally every stock that's out there. the way to think about it is that even though the indices were flat, these things that made up the indices were all moving in different directions. And that's what TechTrader was capturing and seeing. Going back to Christie's point, a human trader, I think there were articles last year saying that humans are beating the computers, which could be true, but at the same time, a human can only look at so many different stocks. Here, you have a computer that trades like a human being, but it's able to just copy itself on every stock that's out there. There's no limitation in that capacity. What's also interesting, going back to the earthquake and swarm intelligence analogy, as soon as July hit, many copies of TechTrader just started pulling out of the market. Now again, it wasn't like some central chain of command that said, hey, danger, start reducing exposure. Just multiple copies of TechTrader started reducing, getting out of the positions. And what you ended up seeing at the portfolio level was, whereas before we were almost taking 100% long at some point, now we're tightening the exposure to the point our net exposure was around 20%, the low of the year. Lo and behold, just a month later, we had China happen, and the market dropped about 11%. TechTrader dropped about 5%. If I didn't point that out to you, you probably wouldn't even notice that it dipped. The reason being is not so much that it predicted the market was going down, it just was able to see all this happening underneath the surface. The other analogy I like to give is kind of like, if you see a cliff fall from a distance, it looks like it just fell on its own. But a lot of times if you were there, if you were like looking up close, you could probably see cracks start to form, bits and pieces starting to fall before the major collapse. That's what TechTrader is seeing. It's actually on the ground, seeing all these individual names get weaker, start to collapse before the overall index does. That, I think, is a really big advantage at a portfolio level, even though it actually doesn't have a portfolio awareness. So most of you are probably curious now is, we've seen what it does at a portfolio level. What does it actually look like when it makes a trade? I'll go over 2 ways that it makes trades. There's really 2 sides of every trade. It's what you pick as a stock, and then your timing, entry and exit. The timing is actually pretty blatant, pretty obvious. A lot of times people ask, like, well, how do you do it? What do you look at? It's really visual. A lot of times when TechTrader makes a trade, you could look at that and you could think, okay, S&P dropped 10%. It's probably a good place to buy. It's not so much, a lot of quants I know, they're thinking like, all right, sell on Fridays, buy on Mondays, or look for like a certain number of days when the market typically reverses. For me, I like to stay close to the source. If no one's trading, the information is useless. If everybody's not actually putting in what they say they're going to do, they're not acting on what they say, that's also useless. The source is essentially the trade that you see in the market, price and volume. What's interesting here is that a lot of times people are overzealous. They're trying to make trades every day. What you have here is a system that, for the market timing side at least, on S&P 500, it only makes a couple trades a year. What you see here is a chart from the last 3 years. Look how few of the trades are. In 2015, it waited until August when the market actually dropped 11% before it decided to step in. And then after that, after a couple of days, it got out because it didn't want to get caught on this whiplash. It's that kind of conservatism that I build into my systems, and that's why I often tell people, it's not really quant, it's not really high frequency. It's definitely not high frequency. But it's a lot more about just being really good at making these individual trades as opposed to looking at some kind of basket-wide alpha. The other side of it is, even though it makes only a few trades a year on any given stock, you think about it, because you could actually watch every stock that's out there, a few trades a year on thousands of stocks is a lot of alpha for you. Something that you as a human probably couldn't do, but a machine could definitely do. So that's the market timing side. The other side of any trade would be, how do you pick your stocks? How do you decide long or short? That other side would be mainly order flow and technical analysis. But keep in mind that I taught myself to trade. So when I say technical analysis, I mean price and volume. I don't mean patterns that you would get from a book. I actually never read any technical analysis books. The interesting part is that when you actually look at the way TechTrader picks long or short on individual stocks, this is US Steel in 2014, you'll notice that same level of conservatism. Because it's a machine and it has all the patience in the world, it's very opportunistic. It's not in a hurry to get in any name. It looks for very ideal conditions, such as volume accumulation, For US Steel here, before earnings, I noticed that people on the majority were paying a premium to get into the stock. What I mean by that is that for every trade that happened on the stock, people were bidding it up. At the same time, if I say that to somebody, might think, okay, so you're just doing momentum trading. As soon as a stock goes up, people bid up the price, you're chasing after it. But that's very easy to get caught in something that just falls right back down. When you look at where it got in, you'll notice that the stock was still relatively flat. It's something that you, as a human, will look at that and think, okay, people are bidding it up, but it's not too late to get in. Those are the kind of conditions that TechTrader looks for. Quite soon afterwards, we had earnings, and the stock jumped about 24%. Here's another way that this differs from quant, high-frequency algos. TechTrader actually just got out pretty quickly. It liked the stock up to that point, but once it started going straight up, it looked scary. As a human being, you would look at that and say, okay, I got 24%, I'll get out. I have no idea what the stock is going to go up or down. People often criticize me looking at that chart and saying, well, you left a lot of money on the table. The way I explain it is that TechTrader quite literally just could no longer read the stock. When it's not able to read what's going to happen, it just rather stay in cash. Needless to say, even though the stock went higher, it actually started breaking down as soon as it made the next high. Enough so that TechTrader actually shorted it. But again, because it was still at a wider range, still on an uptrend, it only shorted it temporarily. It wasn't until it broke that uptrend in November that TechTrader decided to hold the position much longer and short it all the way down. Coincidentally, when it broke that uptrend, that was actually the day that OPEC announced we are going to pump the market with oil. So if you weren't aware that this was automated trading, you would think that TechTrader was aware of OPEC flooding the market with oil and that all the oil names were going straight down. TechTrader, again, has no awareness of this. It doesn't actually read the news. It doesn't understand what OPEC is, what oil is. It just knows that every person that was trading this wanted to get out as quickly as possible, and they were willing to really, really undercut the price in order to get out of the position. At the same time, TechTrader didn't stay on it forever. I know some people that were in oil, they were right in the long run that oil kept going down, but they rode a lot of pain the following year just to stay right on the short side. What happened was seller exhaustion, something that as a human trader, I was pretty keen and followed pretty closely whenever I was short any name. A lot of times it can actually mark the bottom where you want to buy. What seller exhaustion is essentially, even if a company is fundamentally bad or longer term trend is going down, there's a point where everybody that wants to sell has sold. The way to think about it is imagine everybody was trading the stock. It has to go to somebody. Once you get to a 30% drawdown, who's left holding the stock? Everybody that has it bought at the bottom. And that's what you see here with the volume. There was so much turnover that essentially everybody that was now holding the stock is in at this really low price. Even if the stock should go down, who's actually going to sell it? So that's the thing that TechTrader tracks and keeps awareness on. Even though it knows that the stock is in a downtrend, it just thinks the risk reward isn't there anymore. So that's how TechTrader decides long and short. A lot of times, once I pull back the covers, people realize that, hey, it's not really anything different that a human trader would do. You're right, it's not. That's kind of the point. It's not so much that I'm trying to build a machine that's outperforming any human that's out there. I'm actually trying to build a machine that replicates what I would do, but just at a scale that I probably couldn't do or would want to do as a human being. The way that's nice to confirm that what it's doing is actually very human-based is that even though it looks at thousands of names, on average it only has about 50 positions. I mentioned earlier that you have a copy of TechTrader on every stock that's out there, but even though there's no coordination, on average I only have about 50 positions in my portfolio. That, I think, is really good confirmation that we're not just chasing everything that goes up or everything that goes down. We're not just buying everything that's cheap or selling everything that's expensive. It's actually very selective. If it's not sure where a stock is going, it stays in cash. The very interesting part is that the system actually has been in 60% cash since November. which was a good thing considering that this year is like the first year we had a 10% correction in January. Things like that, people are always like, well, how would you know? What, if you were a trader, I think everybody was talking in those 2 months saying that this might be the first down winter in a long time since the Great Recession. Things like that, tech trader is not in the conversation, but it can see that kind of behavior in the markets. So naturally, the next question is, okay, if it's so obvious you're creating a system that mimics a human being, how do you actually create the algorithm? It's like, is it AI, artificial intelligence? Interestingly enough, I only recently decided to take on kind of the label of artificial intelligence on the system because it's not really artificial intelligence. What I mean by that is a lot of, okay, so before I go into why it's not really artificial intelligence, let me explain what that label is now used for. So people equate artificial intelligence with machine learning a lot. But when you look at what people call machine learning, a lot of it's just classification, pattern recognition. There's deep learning, there's neural networks, but what are they actually doing? They're just bucketing information, sorting it. They're not really things that make decisions. They're more things that are like these 5 senses you have as a person. They're like the muscles you have in your hands. Quite literally, we talk about training neural networks through repetition. But when you think about it, as a human being, you don't really do repetition to learn. That's actually what people advise against when you're in school. It's like you don't ever want to just like repeat the same problem or like do things over and over again to memorize it. That's something more you do, like let's say in sports, if you're trying to get that ground stroke in tennis, you repeatedly do that to learn and train your muscles, so that you as a person no longer have to think about it, which is kind of ironic since that's the way we train a lot of what we call machine learning. We do it through repetition because we think we're making something that thinks, when actually that's what we do for ourselves to not think. But we do have some algorithms that are closer to what a person or an intelligence does. A lot of it is on the reinforcement learning side, agent-based systems. The issue is that, at least based on the conversations I've had with some of my colleagues, is these aren't very practical. When I say practical, I mean business applications. But it kind of makes sense if you think about it, because what do you define as intelligence? I would say a lot of animals are intelligent. Like your dog is intelligent. But just because it's intelligent doesn't mean it's actually practical or useful for business applications. You probably wouldn't find it useful. Your dog or a dolphin might be super intelligent on the scale of what's out there, but you wouldn't find it useful for helping you do like a trading startup or a business startup of any sort. That's why we have more the pullback towards machine learning, where it's essentially replicating your human senses but augmenting them. So it's not really machine learning as much as it is just augmenting the human senses to aid the human being. For me, however, because I was essentially trying to build something that replicates myself, this is a much closer to what I built in TechTrader than it is to what's currently out there. Some of the differences, so I actually built the system from scratch when I was in junior year. This actually came after the fact that I built a system. I realized, okay, what's the closest thing to what I'm doing? It would be closer to reinforcement learning than it is to the other machine learning stuff. But a key thing that, when I sat down, I built TechTrader, and when I'm thinking about AI, one major difference is that a lot of these algorithms are objective-oriented. So that when I say objective-oriented, I mean you have an objective function, and they all hone in on that function to try to optimize it. If they're trying to get reward, they're trying to maximize reward on a certain fixed state of the world. If you go into an analogy on how a person is, it's kind of like if you were born only wanting to survive and to eat, but that was your goal for your whole life. That kind of puts a cap on what you're able to do. You wouldn't ever really be able to progress on your potential, on how much you can learn, if you're never able to learn something better than your original goal. So one thing that if you guys have read the AI post that I have on the website, one thing I've mentioned is what I think to really make the algo able to learn one thing you need to do is give it the ability to learn a new goal. It's kind of weird to think about, but it's best thought of in the analogy of the human being, where if you started off only wanting to survive and to eat, at some point you might learn that a person helping other people would get you the food to survive. That's kind of what we have for reinforcement learning and of these other algorithms. But what I'm proposing is, what if at some point you actually learn to value helping other people above just surviving and eating? That's something that's pretty interesting to toy with. And what this might actually allow is that at some point, even though the system starts with a slate of preset goals, kind of like our instincts, at some point it might actually learn to have completely different values. You could even say morals or something close to free will. But when you get to that spectrum, then you run into the danger of, well, how do I control it? Because by definition, you can't actually say, all right, whatever you decide, whatever you learn has to benefit me. Because at this point, the system is learning what it actually should or should not do on its own, regardless of what you input in the beginning. So that's, at this point, I don't actually have something as fully fleshed as this in TechTrader, but it's closer to what TechTrader is than what a lot of these other algorithms are. Longer term, my personal project is to actually expand the algorithm in TechTrader so that it can be applied to other things besides just trading. So a lot of you are probably curious is, well, if neither of these algorithms are really what TechTrader is doing, how is it that you might build something like TechTrader? Well, it's not so much that these algorithms aren't what TechTrader is doing, it's that they're different pieces of it. A lot of what I do, I model after myself and how I think and what I think makes sense. And when you think about what's currently out there, the machine learning on the left, and then the more reinforcement learning on the right, well, how do you arrange that so it actually behaves like an intelligent creature? Machine learning, what's out there, behaves more like the five senses. How do our five senses feed into our mind? Well, you don't really think about your senses. Those are handled at the lower level. What you consciously are aware of are things that have already been filtered and cleaned up by your five senses, and they go into your mind where then you are conscious of more of the high-level stuff. Kind of like if you were thinking, all right, I'm going to run over there. You don't actually think about every step you take. Your body kind of automates that. And that's kind of what we're doing at the machine learning level. We're automating a lot of tasks, but we kind of, this is kind of the reason I don't like to use the term machine learning. A lot of what we call machine learning is really automating tasks so we don't have to think about it. Whereas I'm more interested in the spot of thinking about making something that can actually think about what it's doing. So is this actually something that can think and mimic what we do as an intelligence? There's one thing that I think that people haven't really tried putting together. So something like this I'm starting to see more recently. Some people have put together things called deep reinforcement learning, which is essentially like combining deep learning with reinforcement learning. But something that is still untouched that I think is interesting to explore, that TechTrader actually kind of does, is simulating imagination or creativity. And it sounds kind of hocus pocus at first, but when you think about what it is your mind is actually doing when you do that, you're running simulations in your head constantly. So to put it in more layman terms, let's say you're dreaming or you're hypothesizing. You're essentially looking at the situation before you and trying to run a mental simulation of what could happen. What if? What if I made a different choice? Or when I make a mistake, what could I have done differently to make it work out in the actual ideal situation? More importantly, and I think this last bit is actually quite important, can I learn from observing other people, other situations that I was not in? So something that kind of irks me is that even when you look at something like AlphaGo, Google's DeepMind, recently they played against a human player. One thing that the human player mentioned was that the other system essentially was learning from millions of games. On the fly, if the human did something completely unexpected, creative, the system, that would be like its blind spot. For me, I think the way to cover that blind spot would just be to imagine yourself in the other person's shoes. Or imagine something that might throw off your opponent, and how would that work out? Mental simulation without actually having been there to feel that mistake. In a trading scenario, something with like TechTrader, what it might do is it might make a trading decision like, I would buy the stock. But at any given time, it would also be running a mental simulation thinking, all right, what if I sold that stock? What would have happened? It's keeping track of all these alternative situations that could happen and learning from each case, even though in a single time series is only making one decision at a time. That, I think, really beats just doing millions of trials and error over and over again. That would be interesting to explore. The interesting part about all this is that none of these technologies are unavailable. A lot of what I list here, if you want to do simulation, trading is easy. It's just backtesting. So quite literally, as you're making trades, you're backtesting all the alternative decisions you could have made. For a more general AI, of which I'm interested beyond TechTrader, we could be exploring the use of game engines or like other simulators that people even use in their industrial situations. The interesting part about all this is, I think if you step back, you realize that at a high level, what I'm essentially doing is trying to apply a lot of common sense to the way I write the algorithms. Nothing I really do, at least at a high level, is quite that surprising. But sometimes we get too caught up in all the stats and all the academic work out there that we forget that our own human minds don't really do all that when we're thinking, when we're looking at all these different things. Before I close, a nice analogy I like to give to people is the easiest way to visualize how I approach artificial intelligence versus what's currently out there. Think about when you're crossing a street. So a lot of people, I'm sure when you're crossing a street, you don't actually look at all the things around you and think, all right, what are all the variables, probabilities? And what's the probability that I survive crossing the street? You actually just look down the street, see that there is no car. And then quite literally, it's physically impossible for you to get hit. That's very similar to what TechTrader is doing. It's not so much that it's crunching a bunch of numbers and stats to figure out what trading decisions it's making. It's actually just thinking of all the cases out there, looking for all the car wrecks that could happen and just canceling it out. If you don't let yourself get into a situation that you could blow up, then you can't blow up. It sounds absurd, but sometimes we get so caught up in all the correlations that we forget. For example, if you're going to get blown up by a stock, you have to first be invested. And if you have a portfolio, you quite literally can't blow up if each position is only a few percent and 60% of your portfolio is in cash. So things like that are worth thinking about, I think. And that's the end of my presentation. That's TechTrader. If anyone has any questions, feel free.